for joining us for the monthly Houston Economy Series. This is our final webinar of this series for the year, but we are not done with Patrick Jankowski this year. He will be back presenting to our members and the business community his Houston Region Economic Outlook on December the 8th. So we hope that you will join us for that event. And the information for Houston Region Economic Outlook is on our website at houston.org/events. But again, today is the final webinar for the Houston Economy Series. And a special thanks to our sponsor, PNC Bank, for sponsoring today's event, as well as all of our series events, which we started back in June. Thank you also to PNC for sponsoring our Business by You podcast. Both of these are excellent briefings on the economy. So if you have not had a chance to view the podcast, you're able to subscribe to that as well. Now, I'll turn things over to Julie Suddeth. As you'll recall, Julie is the representative from PNC Bank, and her title is Executive Vice President and Regional President for Houston. Julie, thank you so much, and thank you, PNC, for being a sponsor for this series. We can't wait to have you back next year. We understand you will also be sponsoring the series next year, so thank you so much for that. Julie, I'm going to turn things over to you.
Thank you, Carrie, for that introduction. As Carrie mentioned, I'm Julie Suddeth, the Regional President for PNC Bank in Houston, and as many of you know, PNC has been strategically expanding across Greater Houston over the last 2 years. We've added capabilities and business segments to better meet the needs of our clients locally. Recently, we opened a collection of consumer banking locations, which we call solution centers at PNC. In fact, last week we opened our 4th location, which is in Sugar Land, and we have a couple more coming online in the next few months. Our goal is to provide convenient locations for customers to interact with our retail team across the city. So switching gears, given the turbulence in our economy, we all know it's important now more than ever to be up to date with the latest economic data and trends. So we've been so glad throughout 2020 to be the presenting sponsor of the Greater Houston Partnerships Economic Series. With the presidential election just around the corner, we really appreciate the chance this morning to hear from Patrick Jankowski, the partnership's Senior Vice President of Research. Patrick is going to provide his take on the current state of the economy, as well as look at what the most recent census data tells us about how Houston has changed over the last decade. So with that, I want to thank you all for joining the session today and thank Patrick and his team for their great work, and we hope you enjoy the presentation. Patrick?
Very good, Julie. Okay, I'm going to go ahead and share my screen. Carrie, will you let me go ahead and share the screen? Okay. Okay, can I get someone confirm that you are seeing my first slide, Houston Economic Outlook, presented by me?
Got you, Patrick.
Okay, very good. Just want to make sure I don't want to get halfway into my presentation and find that no one's seen my pretty pictures. So let's go ahead and get started. Carrie already mentioned it, but I wanted to mention it again. Partnership puts together a forecast every year. It's always held the first week of December. Normally it's in a hotel. We've had it at the Hyatt, we've had it at the Four Seasons, we've had it at the Omni, we've had it at Intercontinental, Sonesta. This year it's going to be virtual. Like everything else seems like we're doing is virtual, but I want to encourage everybody to sign up and attend. I will be talking specifically about individual industries and what we expect to happen with them in 2021. Plus, we'll also be putting out a formal document with the forecast that anybody who registers for the event will get a copy of the forecast. So it's there. You can go to the partnership's webpage, houston.org events, and sign up for that. So I'd like to encourage everyone to do that. So I'd like to talk a little bit about the recovery. We are well into the recovery that's kind of more like plodding along rather than zooming along. And there are a couple things which are influencing how we recover and what the recovery is going to look like. And it depends upon what you see there on the right-hand side of the screen, the COVID trends, consumer behavior, business confidence, whether we get a stimulus package and vaccine acceptance. And I want to talk about each one of these individually. Let's talk about COVID trends. This is data as of last night. As you can see, almost 43 million cases in the world. At the rate we're going, I'm sure I'm talking right now, we probably are over 43 million cases and 1.1 million deaths. The number of deaths worldwide seems to be flattening, but we are definitely seeing an increase in cases. If you want to look at what's going on for the US, over 8.7 million cases in the US, over 225,000 deaths. And you can see the trend for both deaths and the number of cases is on the way up. That's a concern, because if you look at the line there, you can see we are pretty close to where we were in July. And you can see that 7-day average is actually above where we were at what we thought was the height of the pandemic when we first went into the lockdown. And so the question is how are we going to respond to this? Because the way we responded back in March and April is we shut everything down. I really don't think that's going to happen. I think another lockdown is highly unlikely. And it's unlikely for a number of reasons. For one is the political willpower just isn't there to shut down the economy now as we shut it down back in March and April. I think there's a recognition that the economic damage for something like that is just really too great. Consumers are already very cautious in their behavior, and businesses are very cautious in their behavior. Yes, we are seeing a spike, or we're seeing an increase, but I think everyone's willing to do voluntarily what they can do to try to get it under control. And I don't think anybody wants to go back to where we were back at the end of March, early April, where we simply shut everything down. Now, as an example of how businesses are being cautious, this is a slide I pulled off the internet. You can see it's the average occupancy rate of commercial properties across the US by people using their Castle entry card. A lot of us have little cards that you use to enter a parking garage or enter a building. And so what Castle has done is it's gone back and looked at these cities and find out where are we compared to where we were prior to the pandemic. And you can see the 100%, and you can see where we are now. I mean, this looks like a bunch of silly string on the screen. But you can see even as we're trying to ease up on restrictions and get people back to work, we're still at about 40% in the best case scenario. And there's so much string here, I can't quite figure out Houston, but it looks like on average, we're only about 30% reopened. And I don't expect to see that to pick up until we do get the virus under control. Talked about consumer behavior. That's both consumer behavior, both in the purchasing standpoint and consumer behavior in the sense of how willing are people to comply with mask requirements and social distancing and so forth. It's interesting, there was a survey done by, of all people, National Geographic. I never thought of National Geographic as a sort of organization that would be doing a domestic survey. But they asked the question, how often do you wear a medical or non-medical face mask when you leave your home? And you can see down here, they ask whether it's always, sometimes, or rarely, never. They conducted this in July and October. And you can see the results there on the screen. You can see that by and large, people are much more willing to wear a mask than they were just a few months ago. And it goes across all generations. It's no longer one of those things to where, well, only baby boomers or only the older generations are willing to wear a mask. It's pretty much across all generations now. So hopefully with more people being willing to wear a mask, it will help us eventually get this thing under control, although I am concerned about the spike, and allow us to keep businesses open if people are willing to wear a mask and practice social distancing and so forth. Social distancing is very important to a lot of industries, especially restaurants and bars and arts and entertainment. There's a website out there called Houston Eater, and they did an online survey. It's not a scientific survey. It's just people who logged on to their website and asked them a question about how do they feel about dining out right now. They actually closed the survey out last Friday, so it's fairly current. And you can look and see that right now, there are only about 6% aren't comfortable with eating out or dining out. The vast majority are still ordering takeout, but you're looking right here, and over half of Houstonians who are eating out are willing to do so. Some are comfortable dining indoors, some only outdoors. Now, that's part of that social distancing. People are accepting that and embracing that, and part of wearing a mask. And you can see that also in the data which I've showed in the past about restaurant activity, or if you look at, rather than being at 0. We're at about 30% of where we were for capacity for the restaurants that participate here and open table. Social distancing, I think everyone has accepted that. Now I go out and walk in my neighborhood, and it's interesting as I'll be walking down the trail, people actually either I will step off to the side of the trail, or the person I'm approaching will step off to the side of the trail, or if I'm walking in the street, people will cross the other side of the street. I think it's no longer, people aren't as reluctant to social distance. Yes, there are some out there. We hear about the parties and so forth. But I think people are accepting that as a normal way of life, that we need to do what we can to stay apart from each other. And that's one thing which is helping the economy continue to recover. I mean, there was a group out there called Morning Consult, and they asked the survey respondents questions about how comfortable do they feel going out doing a number of things. And you can see it right there, not quite as strong as I would like to see, but you see about over 40% of adults, they do feel comfortable going out to eat. About a little over a third feel comfortable going to the shopping mall. But it does start to go down. And I guess when you look here at movies, a gym, concerts, museums, this is that category. It shows up in the data as arts, entertainment, and recreation, which is one of the categories which is still struggling out there. But I wish they had the data from going back, and maybe they do. I just couldn't find it to earlier in the pandemic. But we are starting to see people a little bit more comfortable with going out and wearing their mask and practicing social distancing. So, as I said, consumer behavior, both willing to go out and spend money and willing to practice social distancing, good social practices, are something which is helping nudge the economy along. Business confidence is actually picking up, and that's a good sign. Business confidence picking up, meaning they may be willing to hire more or make some more investments, maybe extend themselves a little bit. And this is a survey done by the National Federation of Independent Business. You may see it sometimes referred to as NFIB. It tends to be the broad U.S. type chamber for small businesses in the U.S. That's what it's considered, as a small business chamber. And you can look and see, they ask a whole bunch of questions about hiring and investment and so forth. They weight them and come up with their optimism index. And you can see how far optimism fell. And you can see it picked up, not quite back to where it was prior to COVID, and definitely not to where it was from 17 to 19. But you can see, by and large, small businesses are much more confident about the future going forward than they were just 2 or 3 months ago. CFOs, this is CFO Optimism Index. This is done by the Federal Reserve of Atlanta and Richmond, and along with, for those of you, that's Duke University, it's Dual University. Carrie, that's one we didn't get when we were proofing. I'll have to be more careful next time. But you can see the CFO Optimism Index. They asked the participants to rate on a scale of 0 to 100 their optimism about the U.S. economy. Once again, this is a pattern. It's almost every graph almost looks the same times. Sometimes you see this spike downwards, and you see this pick up. Once again, it's not back to pre-pandemic levels, but you can definitely see that CFOs are much more confident about the outlook for their organization than they were just 2-3 months ago. And then we get over here. This is NABE, the NABE sales outlook. This is the National Association for Business Economics. It's an organization that I'm a member of. I served on the board a few years back. We do a survey once a quarter, and we ask these economists about their firms. And these are economists that work for large multinational corporations. Some of them work for trade associations. Some work for smaller organizations that can afford to have an economist on staff because they needed the forecasting. We ask them a whole series of questions about sales and prices and hiring and so forth. And you can actually find this information at the website, nabe.com. But the question was, at the end of the first quarter, and I'm actually part of the survey panel right now. At the end of let me back up. At the end of the first quarter, we asked the participants in the survey, what are their expectations for sales in the second quarter? So this is what the panelists expected in the second quarter, as we asked them back at the end of March and the very beginning of April. And they expected sales to fall in the second quarter. Only 1 in 5 thought to be unchanged, and very few thought it would be rising. But then we get to the third quarter. So back in June, we asked, what do you expect to see going forward in July, August, and September? And you can see how dramatically it went from 67% expecting falling sales to only 24%. only 34% unchanged, but you can definitely see that 42% of the economists who were responding on behalf of their organizations thought that the sales outlook was improving, that they'd see rising sales. And then the survey that we just completed, it was released actually at midnight last night. And you can look and see the number of respondents, or the share that thought that sales would be falling in the fourth quarter has really shrunk. So you can see going over the last 2 to 3 quarters, I went from 2/3 thought that we would see their sales falling to only about 12%. And those, you can see those are rising and unchanged. So based on this national survey, it looks like businesses are a little bit more optimistic, definitely more optimistic than they were in the second quarter, and growing optimism about that they're going to see their sales. Very few are going to see their sales fall. Most are going to see their sales rise, or at least remain unchanged. So that's a healthy sign right there for the economy. Of course, the big question once again gets down to the stimulus package. The election is what, 7-8 days away. I'm very skeptical that we'll have something done prior to the election. I'm not sure how it would benefit either party at the polls to have something passed. They may still be negotiating, talking, but that's one of the things which is holding us back. One of the things which would help us, we're in a recovery. The recovery is kind of plodding along, very, very slow. There's talk that we need $1.8 to $2.2 trillion in stimulus out there. But this is one thing that if we could get a stimulus package, it would give us a little bit of nudge. It's kind of like if you've ever gone horseback riding, you've gone on one of those trails, and the horses have ridden the trail for so long, at some point they just kind of slow down, and they're just content to go at their own pace until you spur them a little bit. And then they'll pick up the pace and you're going at a nice pace. It's kind of like that with the economy right now with recovery. It's just kind of going on at a very slow pace. And we need to spur it a little bit. We need to kick it with our boot or something. And that's why we need this additional stimulus. And the other thing that would really help us with the recovery is when the vaccine gets out there. And when it does get out there, if people are willing to take it, there's talk for herd immunity out there. I'm not real convinced on that, but maybe I could be convinced that will help. I mean, at some point, yeah, we will get herd immunity, but it's going to be a combination of herd immunity and enough people with the vaccine. But the concern is, and this is a survey done by the Wall Street Journal and the ABC News, and it was conducted, just 2 or 3 weeks ago. They asked a question: when a vaccine for the coronavirus is available, what describes what you will do? And if you look at it, 20%, only 1 in 5 of the respondents said they'd get the vaccine as soon as possible. About half the respondents said they're going to wait a while. I guess they want to wait to see whether there are going to be any negative side effects. And you see there is a significant number said they're not willing to get a vaccine, or they only get a vaccine if it's required. And so this is one of those things which could slow down the recovery, is the lack of willingness to get the vaccine. Unfortunately, the vaccine has become as political as masks have become political. But hopefully we will get a vaccine. It'll be, what's the word, efficacious? It'll be effective, and people will be able to go out and take it. And that'll be one of the things which will help us with the recovery, but unlikely that we'll have a vaccine before the end of the year. It'll be sometime next year. So that's kind of the things which are affecting the recovery. I want to just give you an update on some of the national data that I've been looking at and what I see out there. Headline, I haven't dropped too many headlines into this presentation. Those of you who've seen me present in the past know I like to use these as my transition pieces. So if you want to see what's going on, monthly change in U.S. employment, we talk about slowing down. Once again, you see the drop off there. And you can see that we continue to have fewer and fewer new jobs created. With this nice surge coming out of the lockdown, and then it's slowing down, which kind of puts us right here. So if you look at total jobs lost, the 22 million, about 11.4 recouped, it still leaves us 10.7 million jobs short of where we were prior to the pandemic. Now, if we create jobs at the rate of 50 to 60,000 a year, that still leaves us 3 years away. If we only 50, 60,000 a month, excuse me. If we're only creating jobs at 200,000 a month, which was the rate at which we created jobs prior to the pandemic, that puts us at least 4 years away. So we really do need a stimulus package. We really do need a vaccine. We really do need consumers spending money and consumers continuing to practice social distancing. So the weekless jobless claims, they have started to decline down. You can see this here. They finally got below 800,000, still elevated from where we were prior to the pandemic. But the good thing, on one hand, it shows that people are still being laid off. People are still losing their jobs, but the rate of layoffs are slowing down. And so that's a good sign. So we're not having to make up quite as much ground for every job we lose. We're not having to create, we still need to create jobs, but when we were losing jobs at the rate of 1 million a week, no matter how many jobs we're creating, we couldn't offset the losses. But this is good to see that the number of initial claims is trending down. I've showed you this chart numerous times. Continuing claims for benefits is trending down at a peak of 22.7 million. But this may be the last time I ever use this chart because it's actually not reflecting what's going on in the economy out there. I couldn't just not show it to you, but I want to show you why you'll probably never see this again in one of my presentations. And that's because the way the laws are set up, the way the benefits programs are set up, someone who's on unemployment can only receive it for 26 weeks. And so if you've been receiving it for 26 weeks, anybody who filed for unemployment prior to April 11th has, I guess one way to say it, aged out of the system, or their benefits have expired. And so they're not being caught in these continued claims. Remember I said continued claims is someone who's unemployed, who's filed a claim 2 or more weeks, continuing to file. But after you filed for 26 weeks, you can't file anymore. And so continuing claims are going down, but that's because people are ineligible to file anymore. That doesn't mean they're not getting benefits. There's something called pandemic unemployment assistance, which allows someone who's unemployed during the pandemic to file for an additional 13 weeks of benefits, or file for benefits up till December 31st. That's the way the program was set up. So it's not like they're not receiving any benefit. They're definitely not receiving the $600 a week that they were receiving earlier, but they are receiving something. And if you want to look at the number of people who are receiving these pandemics, this form of extended benefit, it isn't a form of extended benefit, but there are also extended benefits out there. But you can see the way I asterisk the title. They've exhausted their normal state benefits and now are receiving these additional benefits. It's sometimes referred to as PEUC. And you can look and see how it's trended up. And now we've got close to 3.5 million people who've been unemployed for more than half a year who are receiving these pandemic unemployment compensation. The other thing is we're not really getting a whole lot of reporting on what's going on with the gig workers out there. And when people think of gig workers, people automatically see things like Uber and Lyft and DoorDash, but you can see musicians as gig workers, or accountants that go in and work as a contract worker for a couple of weeks or a couple of months, or engineers who are brought on just for a few weeks to deal with a problem, or the people who, the gig workers who work banquets in hotels and so forth like that. All sorts of gig workers. There is a benefit out there that they're receiving that we haven't tracked much, but it's called Pandemic Unemployment Assistance. That's PUAG. There are so many alphabets out there. Those are, they're not eligible for additional state employment benefits. They're typically self-employed and gig workers. And you can see that peaked at about 14.6, but there's still 10.2 million gig workers out there that are receiving some sort of compensation because they have not been able to go back to their previous level of earnings. So as I keep on going through this, there are actually 8 different forms of unemployment benefits out there. Now, this comes from the Department of Labor. There's something out there called the U.S. Employment and Training Administration. They put out press releases every Thursday. You go to, I think this is around page 8 or 9 in there, and it lists all these. But there's the regular state ones. That's the continuing claims are federal employee benefits, newly discharged veterans benefits, the pandemic unemployment assistance, that's the extended pandemic and emergency employment compensation, that's the gig workers. There's states have extended benefits. There's some states have there's all these sorts of benefits out there. And if you look at it, back in February, before all this happened, there were about 2.1 million people receiving these benefits. Right now, there are over 23 million receiving some sort of benefit. And you can look in here and see right here, just the number of the ones that are getting these. Where's my cursor? There's my cursor. The ones that are getting their gig worker type benefit are the ones that have aged out of the regular benefit and are now collecting benefits through that extended program. So there's still a lot of people out there collecting benefits. Not quite as many as the past though, because what I've done is I went and looked at a lot of press releases this weekend to try to pull the data off that last page, or that page 11 or 12, 13, whatever it was. And you can see at one time there are 32.4 million Americans that were receiving some form of benefit. And there, some of these are obviously, there were some double claims in there, and that's down to 23.2, but there's still a significant number of workers out there that are not earning as much as they were earning prior to the pandemic. And that is definitely going to affect consumer purchasing. It's going to affect Christmas for a lot of people, unfortunately. And it just goes to show that we still have a long ways to go to get the economy back to where it should be. But you can see we have made significant progress. So as you guys, if anybody who's listened on this in the past, you know, I really like that Wall Street Journal forecasting poll that's out there. And I was going to put it in there again. I wasn't sure where to drop it in, so I'm going to give it its own little slot right here. And I wanted to share this with you. And what I wanted to draw your attention to when I looked at the data, and I went and looked at what I'd put in the last two presentations. You guys realize this is my 10th presentation I've given like this pandemic, webinars like this. But I went and looked at this, and I saw that the survey, this Wall Street Journal survey of economists, they talked to about 60 different economists, and these are from academia and from government and from finance and from industry, and there's some people there that I recognize that are just independent consultants. Ask them these series of questions about interest rates and inflation and GDP, and they're forecasting that when we get the data, and actually this Thursday we will know how much the economy grew in the third quarter. We get what's the first estimate. The Bureau of Economic Analysis will give three different estimates. There's an advanced estimate, a second estimate, a third and final estimate. I think I've got it that there's just three estimates. Of course, I'll probably go back and revise it again at some other point. But if you look, each time they've done this, when you survey these economists in August, they thought that the GDP would only grow 18% in the third quarter. And then when they surveyed them in September, 23%. And now they're really quite bullish. And most of these economists in the survey, these 60 some odd economists, think the GDP grew by almost 30%, really strong growth, which is good to see. But what I was concerned about is if you look at each one of these surveys, what they're expecting in the quarters after that, each time has gotten just a little bit less and a little bit less. And so the most robust growth occurred in the third quarter, and we're still going to see growth, but the outlook is not quite as strong as it was in August. We thought would have close to 6% growth in the fourth quarter. Now it's more like 3.8%. Now, one of the problems when we do surveys like this is we ask, well, what do you think is going to happen? Give us a number. But the question is, we can't ask why. Well, sometimes you can ask why. And so I really would like to go back, and I know some of these guys, I may send them an email, ask them, why did you revise your survey down? But I suspect what's going on is it's because we have not seen another stimulus package that's come out, and the virus is still not in check. We are seeing this increase in cases, and those are probably the two biggest factors right now that are influencing the rate at which we recover. So the point is, yes, we're seeing growth, but the growth expectations aren't quite as robust, but we are still going to see growth through the middle of next year. So that's kind of it for the U.S. economy. Let me talk about Houston. Before then, I need to have a sip of my tea. It's not Earl Grey this time, it's Lady Grey. I got to keep those vocal cords well oiled. It's funny, Earl Grey, on the back of the Lady Grey box, it said, it's a lighter, more elegant version of Earl Grey. So maybe I need to do a side-by-side comparison. So let's talk about what we see going on in Houston. Metro Houston job growth, you can see where we were for our job losses. And you can look here and you can see the path of growth. This is seasonally adjusted numbers. It's kind of a bit of a struggle trying to deal with some of these numbers because of everything which happens in August and September with layoffs and hirebacks related to schools opening or summer camps shutting down or people coming back from vacation and so forth. But you can see we've had some growth. It didn't quite fall off quite the way it did for the US, but it's still kind of weak growth considering how many jobs we lost. Now, if you look at this on a seasonally adjusted basis, 365,000, on that unadjusted basis, 350,000. I mean, let's not split hairs whether you're going adjusted or unadjusted, 350, 365,000. That's a lot of jobs we lost. That's a huge number of jobs we've lost. And we've recouped about 147,000 to date, but there's still 217,000 to be recouped. So once again, that's about 3 years worth of normal job growth we still need to recoup. And if you want to look at it a little bit different way, if you want to look at it as a pie chart, you can see that we've recouped about 41% of what we lost, but we still have close to 60% left to go. So that 217,000. If you want to look at it, this is not adjusted, but you can see how we kind of follow these patterns. And you can see the drop down that we had, the pick up, a little bit of a drop down again, and then starting to pick up again. But you can see where we need to go to get back up to 3.2 million jobs. So right now we're just around 3 million jobs. If you want to see where we are for the job losses, the pandemic losses that we had March through September, how many jobs are we still short? Restaurants and bars are still short about 35,000 jobs. That's with the restaurants opening at about 75% capacity. It's some people being willing to go out to eat, either indoors or outdoors, or at least picking it up through either a DoorDash or just through the drive-through. Some of the bars have opened, some of them haven't. Seems like we're struggling a little bit with getting the bars open. But you can see construction, even though it's an essential industry, we're starting to see a little bit of a slowdown in some construction activities, especially along the ship channel. Other services, that's personal services, that's the beauty salons, the barber shops, and so forth, repair shops. But you can look and see some sectors don't have very far to go. This is September data. I'm really expecting that when we get data for October, that some of these bottom areas like educational services, administrative support, professional, technical, scientific services, and so forth, these three will probably move into the positive territory. But we're not going to get the bump that we always get in the fall with restaurants and bars because people aren't going to be throwing parties the way they used to. And manufacturing still depends upon oil and gas. Healthcare and social assistance, I've talked about this in the past. Pay attention to the social assistance aspect of it. That's daycares. A lot of them have shut down, haven't opened, and so on. And this is energy is still struggling and so forth. So let's get to some of the more specific details. The Houston Purchasing Managers Index, the PMI. Once again, this is my favorite chart, one of my favorite charts. It's that survey of the purchasing managers, asking them about sales and production, employment and backlogs and so forth. And it continues to inch its way up. It's at 53.4 now. Anytime it's above 50, that's good for Houston. It can be below 50 in the service sector side of the economy is expanding, but we really don't start to see any growth in the manufacturing side until it gets above 50. So we're starting to see some pickup in manufacturing activity, not showing up in employment yet. I didn't put the chart in here, but we're still at less than 40 hours a week for a typical manufacturing work week. But it's been above 45. The PMI has been above 45 since June. It's been above 50. It's been above 50 since August. So we are starting to see this as a positive sign for the economy. The rig count seems like it's finally bottomed out. It got down in the 250s and now it's back up to 287. Not expecting to see a significant jump in the rig count because we still have a lot more oil than we need. We're not demanding, we're not consuming quite as much as we had prior to the pandemic. And this has implications for manufacturing down the road. It has implications for manufacturing now. As I read through the news reports, as I talk to other economists, as I talk to people who live in my neighborhood, I live out in the energy corridor, it seems like we're seeing a tapering off of the layoffs in the oil field service side, but we're still seeing the layoffs on the white collar or the exploration production side. And that's actually not surprising because these typically follow a pattern. There's an old expression out there, the closer you are to the drill bit, the more your job is at risk. because you always see the downturn first occur when people pull back their drilling, and then they pull back what they're buying, and then they pull back on how many people it's going to take to supervise operations when you have so few workers in the field. And so the fact that we're seeing the white collar layoffs now tells me we're pretty much getting towards the end of the cycle of layoffs of the oil and gas industry. Now we're down to about 210,000 workers in upstream energy. We can't go too much below that. I wouldn't be surprised though if we hit around 200,000, but at one time we were at 300,000. So you can't cut much more and still have an industry. But the demand for crude still remains weak. You can look at all sorts of numbers from the Energy Information Administration or the International Energy Agency, but I like to just look at refinery capacity utilization. What are the refineries running at? Gives you some idea of just how much diesel and how much aviation fuel and how much gasoline and other fuels are being consumed. And unfortunately, we're still seeing fairly weak demand from because we're not seeing as much capacity utilization. Now, right now, we're around about 73% capacity utilization. Prior to the pandemic, we were around 82. I'm sorry, prior to the pandemic, we were around 87. Really should be somewhere above the 90s. So, when you're looking at that, with our refining utilization right now in the mid to low 70s, and it should be somewhere from the upper 80s to the mid 90s, shows that we're 15, 20, maybe 25% below normal levels of consumption of refined products, which is one reason why we're not seeing a pickup in drilling and a pickup in oil prices. I'm going to talk a little bit about what's going on with construction starts. And this is from Dodge Data Analytics. And definitely you can see the drop off in non-building activity here. You can see that we're actually down over about 4.6 billion from where we were this time last year overall. But this reflects a drop off in a lot of the activity that was taking place along the ship channel and some of the road construction. If you want to look at residential, it's softening just a bit. And you're definitely seeing the softening in commercial, which is long overdue. And I've got a couple of slides. I'm going to talk about the commercial market in a moment. Container traffic at the port is picking up, which is a good sign. You can see how we dropped off in May and June. And actually for September's container traffic was actually above September of 2020. Is actually above where we were in September of 2019. Part of this may just be making up for what didn't take place earlier in the year. Part of this may be trying to stock some of those shelves in the stores. I mean, if you're like me, you go through a number of stores, the shelves still look empty. If not empty, you can tell they don't carry near as much merchandise, especially as you see them moving around furniture inside the store to try to make it look more full. Airport traffic, though, still remains down. It's about a third of what it should be. And I think this number itself may be trying to compare it to September. There's maybe a little pent up demand there, but as I understand, we're seeing more leisure travel taking place at the airport. Sales tax collections, we saw this nice uptick in June. I think that's probably because of people finally being able to get out and selling. But we're not seeing the recovery as strong as we'd like, and we're starting to see weakness in sales tax collections again. So maybe we had this bit of a surge in sales and then maybe settling back down. You pay sales tax on services as well as paying sales tax on merchandise, and businesses pay it as well. So it's a sign that the economy, although it's moving along, it's still weak. Home sales, we're just shy on an annual basis of 109,000. We sold a little bit over 108,000 homes. Excuse me as I take another sip of my tea. If I was standing on a dais, you guys would see me grab my water bottle from the top, and I'd pause there. And I don't know if you're seeing me taking my sip of my tea. So we are seeing just record-setting home sales. That is, once again, it's a result of low mortgage rates and also individuals feeling a little bit better about their financial situation, willing to take the risk. And also people who are maybe in cramped quarters, wanting to get something a little bit nicer, especially if they realize they're going to be working from home. The one challenge just maintaining this pace is inventory is at the lowest level it's been on record almost. We're at 2.5 months supply of inventory. And that is at the current rate that we're selling homes, everything that's listed there will be exhausted in the database, or we've sold within 2.5 months. The last time we saw this was at the end of 2014, the beginning of 2015. And that's interesting, because that was the hot housing market, and that was at the end of a boom. And here we are struggling to get out of a recession, and we're seeing a hot housing market. I think the demand will remain there for housing. It's going to be a matter of whether we can supply enough, either through the resale market or the new home construction market. Vehicle sales, I want to thank Ted and Dan for allowing me to have this data. You can see that vehicle sales is kind of a sign of consumer confidence. You know, most rational consumers aren't going to go out and buy an automobile if they think they're about to be laid off. And so you can see the drop off in vehicle sales. Part of it is because of the shutdown, which took place in March and April, and part of it is just this bit of a concern about long-term employment prospects or short-term employment prospects. And so they're somewhat weaker there. So I want to talk a little bit about commercial real estate, which I haven't talked in a while. This is something that comes from NAI Partners. I want to thank Lita, if she's on the call, for sharing this data with me. A couple numbers I want to point out your attention to, and that is this available total space. It's a vacancy and pending vacancy rate, so to speak. It's space which is vacant, or space that will soon be vacant, and maybe a little bit of sublease in there. And you can see this available space at 27.1%. You can see where it was a year ago, 25.8. It's kind of moving in the wrong direction. You can look at negative absorption. We had negative absorption the last 2 quarters. And you can look at leasing activity and how weak leasing activity is. So here we are. We've got 4.3 million square feet under construction, and yet we're continuing to have negative absorption. So the office market just is going to be struggling for quite some time. Now, if you think about this, if you look at this 27% available space out of an inventory of 240 million square feet of available space, that comes up to around 65 million square feet of available space out there. I mean, that's like all the Class A and B space downtown and all the Class A and B space in the energy corridor combined is being either vacant or soon to be available to lease. So the office market, it's great if you're a tenant. You should be able to negotiate a really good deal. If you are someone who's in construction or an owner or a broker or a leaser, it's a challenge. If you want to look at what we're seeing with the industrial market here, somewhat of a similar story. You can look at the available space went from 9.3% a year ago to 13.1, almost a 4% increase. If you want to look at net absorption, we haven't absorbed very much in the last 2 quarters. You can see how much we've delivered in the last 2 quarters. You can take this right here. We've absorbed maybe about 4.6 million square feet, yet we've delivered about 11 million square feet. So the industrial space, we are definitely overbuilding an industrial. You know, there's a line in one of the reports from one of the brokerage committees. If you look at Class A space, the availability of Class A industrial space in Houston went from 12.5% in the 3rd quarter of 2019 to 18% in the 3rd quarter of 2020. The good thing is we are starting to finally see a slowdown in construction. Now, earlier in the year, we had over 20 million square feet of industrial warehouse space under construction. Now it's down to 16. Hopefully it's slowing down, but industrial is maybe not going to be quite as bad as office space, but the market's going to be very weak for some time. If you want to look at apartment markets, this comes from apartment data. Thank you, Bruce, if you're on the call, for allowing me to use this data. You can see how many units we've opened in the past 12 months and how many are under construction. This, I've told you guys the story before. That's close to 40,000 units coming onto the market in an economy that's lost. That's still shy 200,000 jobs before it should be. When you have so much overbuilding, it shows up. And maybe let's not talk about vacancy rates. Let's talk about concessions, free rent, waive deposits, and other things. You can see right here, 66% of all Class A units out there has some sort of incentive to lease them. And it's actually leaking over into the other markets. You're starting to see concessions in Class B and in Class C and Class D. Basically, half of all apartment units in the Houston area have some sort of concession to encourage them to be leased. So, yeah, the economy is definitely, some final thoughts. The economy is definitely on the mend, except for what we're seeing in commercial real estate. And commercial real estate is going to struggle. Commercial real estate always struggles in a recession, but we entered this downturn with an overbuilt market, and it's only gotten worse and going to get worse. But I want to share a few final thoughts. You know, as I said, this is the 10th presentation I've done on the economy as a webinar like this year, trying to provide some insights into what's going on. And I went back and looked at the very first presentation I did, and these were slides very early in my presentation. And it's interesting that when we first made the presentation, we were just at 800,000 cases and under 40,000 deaths. And here we are now at 43 million confirmed cases in the world and 2.1 million confirmed deaths. And it's interesting, here we are talking about distribution of cases. And I actually thought I was putting them into a plot there, trying to show how many by county. And here we've got just well over 80,000 cases now in the Houston region. So it kind of makes me think about what's going to happen with the economy and where are we going. I really think another massive lockdown is unlikely, as I touched upon earlier. I don't think the political will is there, and I think consumers would balk at that. I think consumers are willing to take, for the most part, take the actions they need to take to try to avoid the spread. But the GDP, it's not going to recover. Total output won't recover until at least the middle of next year. As I showed you in that earlier Wall Street Journal poll, we had a real boost in the third quarter coming from the stimulus, but the stimulus, the checks for the individuals and the PPP loans have worn off. And so that's going to affect it. And that's going to affect not just GDP, but it's going to affect employment. And I'm really concerned that employment won't recover for several years. If you had tuned into the last presentation I made, it took us almost 5 years to return to the previous employment level after the Great Recession. And after the downturn in 1991, it only took us about 2 years. And so we're looking at, in a best case scenario, 2 years, but I really don't think that's going to be the likelihood. I think it's going to be between 3 and 5 years before employment gets back to normal. And it's really going to be determined by the pace. A lot of it's going to be determined by the consumer behavior. That's behavior, how willing are consumers to spend or maybe take on some more debt. And if they're willing to maybe go out to restaurants a little bit more often, if they're willing to wear their masks, or they're willing to social distance. You know, a stimulus package really would speed things up. And although I'm skeptical we're going to get one before the election, I really expect we'll get one after the election. If not after the November election, we'll get one definitely in January when Congress gets back in session. You know, some sectors will never be the same. I think I'm stating the obvious when we talk about the restaurant sector or aviation or hotels or sectors that depend upon large crowds like amusement parks and sporting events. And Houston's recovery, it is going to track the U.S. recovery this time. We're not going to get the help from oil and gas that we got coming out of the Great Recession. And the length of our recovery is going to be very dependent upon the length and the progress of the U.S. recovery. So with that, I want to say thank you, everybody, for tuning in for this, the 10th one. I'm going to leave one more slide on the screen before I let it go, and that is just remind you the forecast is December 8th. And I'm going to try to talk about, or I will talk about, individual sectors, what we see driving construction, employment, and construction activity, what we'll see happening in energy and what's going to drive that, what we're going to see happening in healthcare and in restaurants and retail, all the sectors out there. I'll try to get into a little bit more detail, a little bit less on the U.S. economy and a lot more focused on Houston. So I'd encourage everybody to sign up for the event. So with that, I'm done. Carrie, I see we have a little time for Q&A. I'm going to stop sharing my screen. Okay, and great. I am back to being a real person in a little box on everybody's screen. So
you know what, Patrick, I think most people think you're larger than life. So thank you for your presentations over the last several months, 7 months actually. And as we mentioned at the very beginning of this webinar, this is Patrick's final webinar in this series for this year. We will start up again in the new year. Also talking about the economy, so you'll have Patrick again, but he'll deliver kind of an end of year and a 2021 forecast on December the 8th, that is. And we put that link in the chat. Patrick, there's a couple of questions. And by the way, I think I can speak for the audience when we say we've always appreciated the authenticity of the analysis of the facts. However, we're also, I see comments sharing that they're also very appreciative of the more positive news that's coming out. So glad we're getting that towards the end of the year. Couple of thematic questions that I'll throw out there, and I'm kind of consolidating those comments. But housing market, residential specifically. It seems like there might be an inverse relationship to what's happening in the oil and gas industry with job losses and the contraction there, and also just the housing, the purchasing of homes. Does this have to do? Is this a geography issue where people are maybe moving outside of Houston and that's not being caught in the statistics, because obviously Houston is a large area, and also why employers are moving to the area, but you're seeing an out-migration of people. So maybe there's two questions there in terms of out-migration of people from the Houston area, as well as lots of home purchases in the Houston area.
Okay, let me address that in a number of ways. One is, yes, we've seen drop off in the oil and gas industry, but most of the drop off had already occurred from December 2014 up until the middle of 2018. And we saw a little bit of a pickup. This go around, we've maybe lost 20,000 energy jobs, order of magnitude. I need to go back and look at the numbers. It's not quite as severe as what we had earlier. So yes, the drop off in energy does hurt, but it isn't as painful as it was in 15, 16, and 17. There are people who are feeling more comfortable about their jobs. If you remember when I showed you business, professional, technical services, which are white collar workers, that's just about recovered everything there. Most of the losses in healthcare has been in the social services side, which deals with daycare and other things. So, and if you recall, I had a slide that I had used in an earlier presentation. If you look at just nationwide, those at the upper end of the income scale, they're only about 1 or 2% away from where they were as far as the jobs recovery. So that's one reason that people are feeling a little bit more comfortable about their jobs. They have the wherewithal and the low interest rates. As far as the migration, there is a data which comes out from the Census Bureau on a regular basis. Looked at it, if you go back to, I want to say it's the April or May Economy at a Glance, which is posted at our website. One of the concerns that I've had, and I'm hoping to do a presentation just on this sort of stuff, is that we've seen negative domestic migration in Houston for the last 3 years. And that negative domestic migration, meaning normally if you have positive domestic migration, means someone is moving from somewhere else in the US into Houston. They may be moving from New York into Houston, or from LA into Houston, or from Chicago into Houston. The last 3 years, we've had negative domestic migration, meaning more people are leaving Houston, and I'm talking about the MSA, moving to somewhere else than are moving here. If it's not for international migration, our net migration would have been negative. And international migration is simply anybody who lived overseas the prior year and is now living in the US or living in Houston. And that would include expat workers, that would include ex-military, that would include students, that would include undocumented. It's that whole category of where they lived the year before and where they live now. If not for international migration, our population would be really struggling. Most of the population growth we've had from the last few years has been because of the net natural increase, more babies being born than people dying. If you look at the data, what's been impacted most has actually been Harris County, more so than the city of Houston. City of Houston has held up. Harris County has lost, but I can't say we've lost it to the suburbs or we've lost it to other metropolitan areas, because I have not had a chance, and it's been 8 months since I did that analysis, and you know the cliche, I've slept since then. I have to go back and look at my data. And so that's a real concern. Yes, you hear people talking about, my classic one is out-of-state license plates in the IKEA parking lot. How many are there? But we don't know how many people. Those are people moving in. The question is how many people are moving out. And my concern is that there are more moving out than moving in.
Right. Thanks, Patrick. The other thematic question, I've gotten several of them, is regarding the election. I know in previous webinars, we've not necessarily talked about that. This is certainly more about the political nature of the results of the election and how that impacts Houston's economy. Can you weigh in on what you anticipate either way it goes?
Just in very broad general terms. And what I'm looking at is something, there was an article in the Wall Street Journal this morning, which I read, which I think summarizes it very well. It said that the business community is becoming more comfortable with a Biden presidency, if that's what takes place, because Biden would be more, he's not as radical as someone like Elizabeth Warren or Bernie Sanders would be. And he is maybe more predictable than Trump. If Trump gets reelected, though, he will continue to be more pro-business and more working at deregulating things. If you talk about the effect of a Biden presidency on the oil and gas industry, Biden has more control over what takes place on federal lands and what takes place on private lands. If there was a ban on fracking, it would end up in the courts because there'd be litigation saying you're seizing property without due compensation, without due process, or whatever the term is. Most of the fracking which takes place on federal land. So a new administration could say we're going to ban fracking on federal lands, which actually would be beneficial to Texas because there's very little federal land in Texas because the way we entered the union, the land remains state land or private land. If you look at if there's a Biden presidency, you could see there being more, maybe a bigger stimulus package. If there's a Trump president, if Trump stays in office, you can continue to see there's talk of maybe an infrastructure package. So I'm trying to be very neutral. I'm trying not to show how I lean one way or the other. I'll let you know. I'm more comfortable with Biden than I would have been with Elizabeth Warren or Bernie Sanders, just pretty straightforward. But I can live with either one of the two candidates. And I don't think, although Biden has had some gaffes and then there's concerns about how he would treat the oil and gas industry, I think whatever happens wouldn't be, even though they're on day one, I think that whatever happened would transpire over time, and it wouldn't happen immediately because I do think there would be some lawsuits involved in it.
Great, Patrick, thank you. I know a lot of people have that question on their mind right now. I know we're running close on time. I just want to throw this one last question out from Tim Sullivan on minimum wage. So how do you feel, Patrick, an increase in minimum wage will impact our various areas of the economy? What do you think the current wages being paid are, and how many are paying more than minimum? Is that a loaded question?
Actually, I'll just be real blunt. That's something our organization has not taken a stance on. That actually becomes a public policy question, whether we're going to endorse that or not. But I'll do it this way. God, I shouldn't admit. So it's $7.75 an hour now. I'm trying to think minimum wage. Maybe I should know. Let's say if you make $8 an hour and you work a normal year, normal year is 2,000 hours. And so that's $16,000 a year. In annual income. I don't see how anybody can get by on $16,000 a year. And so, and we have not raised the minimum wage in many years, but I just have to be real blunt. That's something that our organization would probably take a stand on. So I need to be careful what I say about it till the partnerships come out with this position, whether we're going to endorse a minimum wage or not.
Great. Patrick, thank you. This concludes today's program. I will just list some of our upcoming events. If you'll direct your attention to the screen. But I also want to thank our sponsor today, PNC Bank. Julie, thank you so much for being here with us. Thank you for supporting the webinar series. For those that are still joining us today, please note that we have a very full week, as we normally do here at the partnership. For our members, these are all complimentary events coming up this week. We do have an event with our Upskill Works group on talent and how community organizations are helping to feed the pipeline. That is tomorrow. We also have tomorrow our Healthcare Council. So learn a little bit more about increasing access for the uninsured. We also have 2 business development or networking events this week. It's great if you want to get out there and meet some new folks or reconnect with other members, and that's our Net Effect on October 28th, and then October 29th, we have our Membership 101, learn more about how to get engaged with the Greater Houston Partnership. Again, thank you all for participating. Thank you for participating and being great consumers of our information. We'll see you for the next event, and certainly want to see you on December 8th for Patrick's Houston Region Economic Outlook. Thank you, and have a great day, everyone.